Yes, yes. So my name is Eric Jaguara, and I'm going to take you just quick through what startup funding vehicles is. So our aim is strengthening local investment networks within Uganda, and we are an open ecosystem project. What means everyone who's interested in supporting this cause is welcome on board. You could go to the next slide. So, what are we aiming at? Empowering our local investors, which in turn will also support the homegrown startups. So, as I said, we are an open ecosystem. Everyone is welcome. One of the biggest challenges in the startup ecosystem is funding, which contributes to about 55% failures in what? Or failures in the startups, and also in turn affects the just general the growth of startups and external investment, because external investors will fear that if they are not seeing our own people also investing money in us, eh? If they are not seeing people investing money locally, they will also get skeptic. They are like, there's something not right about that place. So if we can be able to build our local investor network within Uganda, it will also bring in more money from outside and also generally grow our ecosystem, our startups. So some lessons from some other countries around us, our neighbors. A country like Nigeria was able to raise 1.2 billion in 2020. That is just local investors putting in startups. And then for Kenya, 8% of the GDP was got from just startups in a place called, like, they have an area of startups called the Silicon Savannah, contributed 8% of the GDP. So I think you can see how powerful, if our ecosystem is to be strengthened, how the effect it could do. Mm. As we are crying of the economy, our startups can be the key to improving our economy. And the same thing also in South Africa and in Egypt. $400 million was raised in 2020 by just the local investors putting in their own what, without asking money from outside. I mean, so what is our vision? Our vision is to have a robust investment culture within Uganda, and we are doing this through investor knowledge and learning. We are carrying out educating investors on startup. We are educating investors on startup opportunities, sharing with stakeholders like the government and other innovation hubs and all that, and sharing best practices by industry experts, such as today, this webinar today, uh, where we keep on, we just continuous. We're going to be bringing in various experts to share with us knowledge. Some of the milestones that we have hit so far: we have done various research trainings, collaborated, made various collaborations such as with UNCST, taken part in various key programs in the startup ecosystem, and various fundraising for various causes. Those are some pictures of the things we have been doing, the events we have been at. So what next? We are aiming at pushing more study in our funding landscape, understanding it better, developing, of course, the investor networks with activities like these webinars. We aim at having a startup investment support center, and also we are trying to explore all various forms of mechanisms of funding we could bring up with it locally. And of course, the strategic collaboration, as I said, we are an open ecosystem. We are an ecosystem open project, meaning whoever is interested in pushing this cause, you're welcome on board. It is championed by TechBuzz Hub, but not owned by TechBuzz Hub. Even other innovation hubs are welcome on board, and everyone interested in the good cause. Uh, so we are going to be having various webinars, as I shared. All you have to do is just to add a number, change the number, the last digit of the link that you used to join today. Yeah. After 2 weeks on a Friday, you just simply change that digit, and then down, that's the link. If you are interested in joining, please just copy that, write down that link somewhere and visit it. You'll see our different packages, membership packages. Those packages are not for. Let's go down to the packages first briefly. Yeah. So we have various packages. We are going to read the details about them in that link that was shared above. We're going to go back to the link after. So we have various packages. All you have to do is just visit that link. That money is just to support our activities. It's not for any sort of profit something. No, no, no. It's to support our various activities and starts from 200,000 and even to even open amounts. You can put whatever you wish to put. And of course, you're not limiting to the 200. You can give us even more than that. So back to the. So today's event is the first poster you're seeing, and in 2 weeks' time, on 11th April, we are going to be having another event titled "Who is Can an Investor Be in Uganda, Considering the African Case Study." Don't miss it. All you have to do is just to change the last digit in the link you used today, and you'll be able to log into that one in the next 2 weeks. So when you're done with this, if you do if you're able to attend 10 of these sessions of these webinars, you'll be able to get a certificate of completion, which will help you in the job investment space, jobs in the investment space. Sorry. And if you're an investor, you'll be able to make better investment decisions and even knowledge transfer to other investees. So push and attend at least 10 and get that certificate will help you. You don't know, maybe even have limited you. You could be, there are various doors could be opened by it. So we are located in Tech Buzz Hub, Kayondo Road, Ntinda, Kampala. And those are our numbers you could call to reach out. And you can follow us via LinkedIn. We are called Startup Funding Vehicles. Everyone
Thank
is
you
welcome.
very much.
Thank you, thank you. My name is Eric Jagwara.
Thank you very much. Thank you very much, Eric, for that wonderful presentation. And to our attendees, I want to welcome you once again to Tech Buzz Hub, to Startup Funding Vehicles. And I want to encourage you that you are in the right place. Just as Eric mentioned, you get through this program, get yourself a certificate after attending 80% of the first 10 sessions, which will be like the starter package, or what they could call a beginner. And then we shall have another 10 sessions later, which will give you a different certificate, and continuously we shall be providing certificate after every 10 sessions. They are continuous and progressive in nature, so you're sure that participating in these activities will do you nothing else but good. Again, my name is Kenneth Twesije. I am the team lead and founder of Tech Buzz Hub. Some people love calling me CEO, though sometimes I want to keep a low key. Today we are having a great conversation with someone very renowned into this space. And he is already on call. That is the good news I'm bringing to you. Mr. Riro Jeremy, who is the managing partner of FIE Consult, Nairobi, Kenya, and has quite a number of affiliations, though we chose to only mention Africa Federation of Business Angels Network. I know some of you might be wondering, why angels? Do we have angels alive? For those ones who are not very exposed into this space, I am very sure that he will try to explain what this is. I could not say a lot about him in terms of introduction. I know he will do a better job introducing himself. But before he comes on or before he starts, I want to just mention a few housekeeping rules. Rule number one is, should you want to speak, kindly raise up your hand. We will definitely note that. Should you have a question, you are free to put it in the chat or you note it in your notebook. I encourage people to have notebooks as such a session is happening. So if you can, grab it and then keep your mics on mute until you're called on to speak. But you're very, very much encouraged to ask questions. And as soon as your question comes into the chat, we are most likely going to pause a little bit and we reflect about the question. And then later on, we can continue. With those few housekeeping rules, I want to invite our guest speaker, Mr. Riro Jeremy, to come and take us through. Jeremy, over to you. Thank you.
Hello, Ken, can you hear me?
Yes, loud and clear.
Okay, I hope you're also able to see my image.
Perfect, very perfect.
Okay, great. Thank you,
Yes.
Ken, and the organizers for this series of webinars. Um, I'm elated to be involved in a small way for this session today. Because it fits very well into the bigger picture that we are looking at as we look at economic development across the African continent. Everyone has a role to play. There are those who are doing different things at different levels. There are those who are looking at regulations and the legal structures that we need for development. There are those who are looking at social issues. Others are looking at environmental issues. And while everyone is focused on their different areas, governance in public sector, etc., we also have the entrepreneurs who are really the builders. They are the real masons who are actually carrying the stones and laying each block one at a time to build the continent in their different capacities and the different roles that they play in their various economies. And so, looking and focusing on them and trying to see how do we have more resources channeled to them for to support their growth is something that is noble, something that is very close to my heart, and that's what I do on a daily basis, basically. And I'm excited to be here. So, without much ado, I know our session was timed to be from um, 1800 hours to 1900 hours. Cognizant that today is a Friday, and most of us might be already tired with the whole week of activities, and we might be looking forward to resting. I wouldn't take much of our time uh, with a lot of theories that might not be adding value. I'll try to keep it short and brief to the point, and I hope we are going to communicate as we go along. I am sharing my screen to do a brief introduction of the firm I work with. Ken, let me know if it is on the screen and visible.
Yes, very.
Great. So I work for a company. My name is Jeremy Riro, as Ken had mentioned. I work for a company called FI Consult, FIA Consult. People ask us what FI means. It's basically finance, investment, and economy. That's what we consult on finance, on investments, and the economy. Basically, we are focused on economic development across Africa. That's our work. At a glance, we are basically an advisory firm. Financial advisory is our mainstay, and of course, management consulting, where we do strategy and operations consulting. We have offices in Kigali and in Nairobi. Currently, I'm seated in our Nairobi office, but we work across the continent from those two offices. And our focus areas are basically the transaction advisory, which is capital raising and investment readiness support for businesses, and climate action, where we deal with circularity, climate finance, and other things, and private sector development, where we collaborate with development partners to run and effectively and impactfully be able to deliver economic development programs targeting probably SMEs, startups, etc. in different countries. And our focus in terms of sectors, we're looking at financial services, food systems, renewable energy, healthcare, and manufacturing sectors. Those are out of 5, but of course we are sector agnostic, as it were. We have been in operations for the past 10 years now, actually, and then done a lot of quite good deals and advised a lot of funding deals in the north of $800 million US dollars, headed towards $1 billion US dollars this year. And we have completed engagements in about 13 countries, working from those two offices, like I had mentioned earlier. So that's who we are at a glance. And basically, these slides is just about who we are, and I've already kind of mentioned what we do under each of these things, each of these verticals. So transaction advisory is corporate finance advisory. We are doing project finance. We are looking at capital markets and supporting countries to develop their capital markets so that we can have more capital going into private sector to, again, support the whole goal of economic development. And climate action, we're looking at climate finance, we're looking at circularity and carbon projects. Private sector development, like I mentioned, is working with development partners, governments, and other businesses, just to make sure that we are supporting development programs at different levels. The sectors we are focused on, I had mentioned earlier, in terms of the priorities, no need of dwelling so much on that. Where we work, just again a map showing a snapshot, and where we have worked before. All the green colors are countries where we have done some engagements, and of course you can see the eastern part of the continent is more greener. So East Africa is basically our base, our home, and then we venture into other markets over time. And that's who we are. And so I lead the team at FI Consult, and if anyone has a question or would like to learn more about us, you can shoot us an email, and I'm happy to provide more context. So having said that, let's come to today's discussion. And like I said, I don't want to bore people with a lot of theory. So I'm inviting all of us to really be very active and participate in this conversation. And we want to look at startup funding basically, and us now creating kind of local funders for these startups. On the left side of the screen, we have the local funders that we want ourselves to be. And on the right-hand side, we have the startups that we need to accelerate their growth. We need to fuel their growth. And we need to find how we can do that locally, using the locally available resources. And so at this point, I would like to pause and request that we have a bit of participation from all of us. You get into the chat and you drop your question there, you drop your expectations there, so that we are able to now focus this conversation on what is relevant for the audience that is here. I know we are looking at startups as an asset class and their relevance within the Ugandan context. And I would submit that Uganda is a developing country, developing economy, which is reflective of basically the rest of the 53 countries across Africa. And so when we are talking about the case of Uganda, we are basically talking about the case of the rest of Africa. And we'll dive more into why I believe we are similar and across the continent in terms of where we are, and why the discussion around startups and having local funders for startups is a theme that should cut across different markets. So I would like us to basically get into the chart And if you could just express what your desired outcome of this short session you're going to have here is, I would really appreciate to see those flowing through. Please go right ahead and drop your question there or drop your expectation there. And then I'll be able to tailor the discussion towards what is most relevant. I can see we only have one person who has gone ahead to introduce himself. Agambe, the CEO of Rain Business Development Agency, welcome. Can we have more? If we get about 5 representatives out of 33 of us who are here, assuming 3 of us are part of the presenters. What is our working definition for startups? I think that's a good discussion we should have. Different countries have different definition of startups. We're having startup bills coming up in different countries across the continent, and we are finding the definitions differing from different countries. So the next question here, capital markets of Uganda are in a dire situation. How active are the Kenyan capital markets? Roy, that question is well taken. We'll try to handle that. There's another one from TBH Hub. Would you say investing in startups is better than investing in land and real estate? Good question. And I think I have a strong opinion on it that is sometimes not very popular with the capital holders who invest in land and real estate. They also have a strong opinion about why they invest in land and real estate. Can we get a bit more of others? Just put in your, I can see Dred, CEO of Azuom, welcome. Can we have a bit more of those questions coming through? So that before we dive into a directory that might not be, a direction that might not be very useful, I would like everyone to just express their expectations. I'll give you like 1 more minute, and then we'll kick off. And as you post your questions, elaborate on capital requirements for green energy. Mr. Norman, well noted. As you post your questions, Ken mentioned that I'm affiliated with the African Federation of Business Angel Networks. To provide context, I sit in the executive board of the African Federation of Business Angel Networks. I am the treasurer there, the board treasurer. And basically, the federation is a continental federation of different business angel networks in different countries. And our core mandate is to mainstream angel investments to early stage businesses in Africa. And we come from a point where we are looking at the continent, we are looking at the capital that is flowing into the continent, the startups that are getting funded, we are looking at the quantum in terms of the number of the startups that are getting funded. We're looking at the ticket sizes that most of these investors, the venture capital investors and others are looking at. And you realize just a handful of startups across the continent are getting the capital that is coming from these foreign sources. And we are saying within the continent, we have enough resources to actually support most of our early stage startups that do not require huge capital investments. And one of the ways to support these startups is to have people who are close to them, that is high net worth individuals, other entrepreneurs, professionals who have some surplus income, deploying that capital in supporting the growth of the startups within their respective countries. And so our mandate is to go to markets where we probably don't even have angel networks, or we don't even have people having the awareness of angel investing as an existing kind of concept. Introducing that, creating awareness, training people, equipping them with the resources they need, and getting them rolling with pipeline for them to start supporting their local startups and SMEs, as it were. So that's basically the mandate at at the African Federation of Business Angel Networks, AFBAN, in short. And why I'm excited about it is it aligns squarely with what we are discussing here today in terms of how do we get local investors to view startups as an alternative investment vehicle that they can actually consider and put in their resources. So I see this very much aligned with our mandate at AfriLabs and not AfriLabs, at AFBAN, and I'm excited to share the knowledge that we have so that we can be able to learn and grow, all of us. I've mentioned AfriLabs. I'm also at the board of AfriLabs, which is a network of all innovation hubs across the continent, most of the innovation hubs across the continent. I also sit at the board as a board treasurer at AfriLabs. So that's another affiliation that I have. And so I'm able to see things from entrepreneurs' point of view as innovation hubs support the startups. And we're also looking at the investor side of things as we work with angel networks and individual angels to invest in those same startups being supported by innovation hubs. So it's quite a strategic play there. Now, I'll go into the questions that have been put here. Thank you for all those who have responded. I believe that was a long introduction as we were waiting for people to share their questions here. So the first question that I'm seeing here is, what's your definition of a startup? What's our working definition? I believe the question is being asked in the context of Uganda. What's our working definition for startups? I may not have the precise definition as per Ugandan laws, but generally, when you talk about a startup, you're talking about a tech or tech-enabled venture that has high growth potential, and in terms of it can scale very fast in different markets, create jobs, and basically the high growth component is what differentiates the startups from your typical MSMEs. Because MSMEs basically your businesses in your locality that are making good, decent incomes for the business owners, but they were not created with a goal of scaling to bigger heights and probably even aiming at the unicorn kind of valuation that most startups are aiming at. So I would put it simply, the difference between the startups and other typical MSMEs is, for startups, most of them have a tech component in them, whether they are fully tech companies or tech-enabled, and they are looking at high growth at a fast pace and scaling across different markets and different regions. Whereas your typical MSMEs are just looking at growing a sustainable, profitable business that keeps growing organically and gradually over the years, providing decent incomes to the owners of the business, without the ambition of, fast scaling very fast and achieving very great heights in terms of scaling across regions and other markets. So that's the layman kind of general way to look at that definition. There's a question from Roy. In terms of capital markets of Uganda are in a dire situation. How active are Kenyan capital markets? Let me start with making the point that capital markets across Africa are generally at nascent stages. In every country that you look at, we haven't matured yet. I can't pinpoint one mature capital market across Africa. We are all growing and at different rates and at different levels. Ideally, capital markets are meant to enhance liquidity within the economy so that private sector players can be able to access capital through the capital markets. And that liquidity and availability of different financial instruments through which private sector businesses can raise capital are at different stages across different markets in Africa. And none of our markets can be termed to be mature and fully established, as it were. So you look at markets like Kenya, a good example that you have given there. How active are Kenyan capital markets? You'll find that we have more than 60 listed companies at the stock market. We have a bond market that is active. There's a derivative market that was also launched. And even when you go to the stock market, you have the growth segment, you have the alternative segment. Basically, we are trying to fragment it and make it as easy as possible for different players to participate in the capital markets. But the level of activity and the level of involvement of different players who should be and stakeholders in the capital markets is still not where we would want it to be as a country. And when you go to the stock market, for instance, you'll find of more than 60 companies that are listed there, the counters that are very active are very few. You'll find the big names like Safaricom, KCB, and others are very active, whereas there's quite a number of them that are dormant and not very active. So we are at different levels. Definitely, I would say within East Africa, Kenya is leading in terms of having an active capital market, but doesn't necessarily say that we are mature to the level where we want to be. And why I say so is because we haven't seen yet, now that we're speaking about startups, we haven't seen an exit through an IPO. We haven't seen a startup that has grown and exited, provided an exit option for investors through an IPO at the Nairobi Stock Exchange or Nairobi Securities Exchange. We are yet to get to that point. Some may mention or talk about Safaricom and the M-Pesa story. But well, yeah, if we were to talk about that, then that one was a long time ago. Since then, we haven't had a lot of other exits happening at the stock market. And so that exit through IPOs if you're an investor and investing in a startup and you want to exit through an IPO, it's unheard of across the continent in Africa. It's not a common phenomenon that you get to see on a day-to-day basis. And from that point of view, I would say then we haven't matured enough where investors can invest and they know if this company keeps growing over the next 5 years, 7 years, we might have it listing at the stock market and we have an exit option. So in terms of activity, yes, all of us are growing, but some of us are relatively ahead of others, depending on what is happening. And so I think that one helps in answering your question, Roy. And if you have an additional question on top of that, I'm happy to address it. Then there's a question from TBH Hub. Would you say investing in startups is better than investing in land and real estate? Like I said earlier, I have a strong opinion on this one. I'm fully biased towards investing in startups. Probably my risk appetite is higher than others. But every investor is entitled to their own opinion and how they choose to deploy their capital. In this case, the land and real estate is viewed by those who invest in it as a safe investment. You can see the land is a tangible asset that you can see. Most of the time, the land and the real estate will appreciate as demand, as population surges, as development grows within the regions where you have invested. The valuation will go higher. So there's the upside of capital gains that you can cash in on, and if worst comes to worst, we can sell that asset and get out. On the other hand, the startups is a risky game. You can have the startups today. Policy changes and it affects the business drastically, and you have to shut down the business, or macroeconomic factors that are beyond, and geopolitics that is beyond the startup's control can impact the operations of the business, and it shuts down and you lose your money. And so either side, but on the other hand, if the startup really sticks and grows and scales, you can have an upside that you'll never experience from land and real estate. The valuation of a startup can grow 5 times, 10 times within a short period of time. 3 to 5 years, you can grow the valuation of a startup 5x, 7x. I don't think the value of land can grow 7 times or 10 times within the same short period of time. And so there's an upside in investing in startups, but also there's the safety and the peace of mind that you get if you are risk averse, by investing in land and real estate. But why do I? And I think this question now sets the context for this discussion today. Why am I pro investing in startups? Because, like I said earlier, the startups are led by entrepreneurs and innovators who are really solving problems and challenges that we are facing across the continent, but they're doing it profitably. And so these guys are the ones who are really the builders of the economy. So first of all, if you want to support a growing economy, you want to live in a country where basic services are within reach, you then need to invest in those startups that are innovating and providing those solutions so that they are readily available within reach, whether it is in healthcare, education, whether it is on energy, financial inclusion, and other things, or even products that we use in our homes, food and other things, consumables, and other things that we need within the home. If there are startups that are developing these solutions or these products, then they are the ones that are actually making our lives better. And if we invest in them, we can only get better with our lives, and economically we can only grow. And so, from a very patriotic Pan-African, I believe by supporting these startups and entrepreneurs, by extension MSMEs and other businesses, we are doing ourselves good because they are providing goods and services that we need locally here. And if they're able to do it at a good price, conveniently, then we are able to enjoy, all of us. Number two is the upside that I see on investing in startups. Um, I see huge returns when you do well calculated investments, assessing the risks versus the returns, and judiciously investing in startups that are solving real problems or meeting real needs for a large enough market, and are providing a solution that is more preferred than whatever is in the market. These guys will continue scaling, they'll continue growing, they'll have customer loyalty, and over time, as a scale, then you'll be making more money if you are invested in those startups through the profit distributions once they break even and they start doing profit distributions. And eventually, if you want to exit, you'll exit at a multiple of your investment. And at the exit, I don't think we have other assets that will give you bigger. I don't think compared to land and real estate, I don't think you can have the kind of multiples you can have in a startup. So it is a good investment case because of the higher returns. It's a good investment case for economic development and providing what we need on a day-to-day basis within reach at affordable prices and contextualized to suit our needs locally. And it's basically a good investment case, first of all. But also there is the risk of the downside in the event that the startup doesn't work, which raises the question as to why do some of the startups really don't work? Because failure of some of these startups, some of the big names, even in Kenya here, that have been receiving huge amounts of money, keeps people away from startups because they instill fear in other people who would want to invest in startups. Sadly, as late as today, I saw that one of our big companies, startups, in the buy now, pay later space, one of the leading ones, has gone under administration, which means basically they are they're in an ICU situation and someone else has to take over to manage that whole process. And they just raised, I think, about 10 million US dollars recently. And so people might raise questions as to why should we risk our money in this startup space where we are not guaranteed of returns. So the question then becomes, why are they failing even after raising huge amounts of money, and why should we risk our money then? I would rather go to the safe investments in land and real estate, which takes me back to the real reason actually is around due diligence and how you assess the market that these businesses are serving and the customers, and how you assess their unit economics. Basically, what are their costs that they're incurring when they're running, and what are the revenues they're able to generate from the customers that they're serving, and how big is that market, how big can it be into the future. If you don't spend enough time in that, then you realize you'll invest in something that is a hit today, but by next year it's not. And I think that's where some of our investors are being blindfolded on the due diligence process, and they make quick decisions that end up burning their cash. But if you're able to polish on that end and make serious investment decisions that are data driven, that are evidence driven, that are focused on the fundamentals of a business, the customer and the market, and a customer who is willing and able to pay, and how big the market is, I think you're able to overcome some of those challenges and then be able to draw more returns and have more succeeding startups, which then become case studies that can be referenced and then pull more local investors into that space. I think I dwelt on that more because I think it touches directly on what the topic today was, just putting it out there so that once I stop, we can allow for all the direct questions and we can answer them. Norman asked here, elaborate on capital requirements for green energy. This is a broad question. I may not, Norman, you could probably do us a favor and be very specific at the bottom there. You can add another question down there, just building on it, so that we know what you mean. Because in green energy, you could be doing solar home systems, you could be doing commercial industrial solar, you could be doing biogas, you could be doing wind energy, and depending on the size of the project, the capital requirements are going to be different. For smaller projects, you'll need a small ticket size. For larger projects, you'll need more money. So if you can elaborate more, I'm happy to provide more context. And we have done quite a number of deals as FI Consult on the green energy space, on solar home systems, specifically on solar home systems and commercial and industrial level, and a few mini grids and a couple of utilities off grid, but connecting to grid. So I'm happy to elaborate more once I get more context on that. There's another question here that what would be your take on overseas investors taking the largest, if not the only people investing in startups? This is a very good and provocative question here. The way I would respond to these, and I'm just reading these questions as I respond top of my head, so some of the answers might not be politically correct because I'm just sharing the honest opinion in my head. So my take on overseas investors taking the largest, if not the only people investing in startups. So my take is we've just let ourselves into that situation. There are two ways to look at it. First, we have let ourselves into that situation because locally we are not supporting our startups enough. We are not putting aside capital to assign to the startups. You go to a lot of our countries, and you find that the assets that even the insurance companies, the pension funds are allowed to invest in, as per our country policies and regulations, they don't tolerate the high risk alternative investments like venture capital and private equity. They are all on government bonds. They are allowed to buy stocks at the stock markets. They are allowed to invest in real estate, and they do that quite a lot. But you see, they are not allowed a good portion that can go into VCs and other alternatives investments. And if the policy and the regulatory environment is not favoring that and providing guidance and a framework under which you can safely invest in startups through either whether you are a VC, whether you are an angel investor, then without those safeguards of law, without those legal safeguards, investors will choose to go to where there is clear regulatory frameworks and invest in those vehicles, including real estate and land and government bonds that are presumably the safest, until we realize they are not when the Ghana situation happened, where even the government paper was, the government bonds were losing value. So the point here being, we have not consciously taken the step as a continent and even as countries, specific countries, in this case, Uganda, Kenya, and others, to bring up the aspect of these alternative investments into startups as an investment vehicle, as an asset class that need to be considered by the capital holders. The largest capital holders in terms of institutional capital holders, we have the pension funds, the insurance company, and other investment companies. And they are regulated by the capital markets authorities in different countries, and especially for the investment companies. And you find the allocation of capital is not really in favor of the very high risk. In Kenya, I think we have a policy that talks of probably up to 10% can be invested in alternative investments, and that's where investing in startups would fall, but doesn't provide really broader context and support for that, and so it leaves people hanging. Across the continent, I don't think there's any country yet, as we speak, that has direct policies that govern angel investments. And that's also another thing that we're trying to look at the African Federation of Business Angel Networks. Like, how do we make these business angel network, not angel networks, but angel investing? How do we mainstream it? How do we make it a recognized asset class legally in different jurisdictions by working with different stakeholders within those jurisdictions? Because the moment you have a legal framework that through which you can invest, then you'll have more capital flowing into the businesses. So it's our own undoing by not having the right regulatory frameworks to support that. The other thing I would say is the other take I have is you just have smart investors, people who have seen the potential here, and they happen to come from outside the continent. They are seeing high returns here than they are seeing in their home countries, in the developed economies. And so they're coming just to tap into that opportunity. And it's a free world, and we welcome capital for as long as it serves our interest here, and they're able to make their returns. I see no problem at all having foreign investors coming to invest in the continent and in our startups here. Now, the question here, when you go to discuss it deeper, would be around what happens when they come and own a significant percentage of most of the lucrative startups locally, and then we are left in the woods. So ideally, it's probably the 20th century neocolonialism or colonialism from an economic angle, as it is discussed in the streets here, which is a fair argument. And then the counter argument to that would be, what are we doing ourselves to ensure that we are having a stake in these startups? And you'll notice even some of the big startups in Nigeria that have gone global, and they're really big unicorns, they all started with local investors putting in a bit of their monies in them. Talk of Flutterwave and others. They have local entrepreneurs, local innovators and investors who put their money there as angels and supported them to scale. So we can be part of the investment landscape if we want to. But if we fold our hands and stand aside and put all our money in other asset classes that we consider to be safe, then the investors who have a higher risk appetite and who are seeking higher returns will come from outside and eat our pie as we watch. So I think we just need to be more proactive, and I have no problem with foreign investors coming and investing. It's the same case. If I find an investment opportunity in the developed economies, I'll definitely go there and invest if the situation there allows me to. And so it's a fair marketplace for all of us to play. We just need to be more proactive and encourage our local investors. There's a question from Shoki. We are establishing an innovation hub addressing gender, digital inclusion, climate inclusion, youth development, and digital inclusion. How best can we avoid innovations from the dying at the initial incubation stage? So Shoki, this is a good question because we also run innovation hubs here. And there was a thread I saw on LinkedIn earlier this week, people are bashing Kenyan incubation spaces and accelerators, innovation hubs basically, and saying they're just there for hosting events that are almost the same, training people on almost the same thing, business model canvas, and all those kind of basic things, and they replicate the kind of talks, go-to-market strategies, and whatever, and they are not really adding true value to the startups that come to their spaces. And I 100% agree with that kind of sentiment, where you see a lot of innovation hubs that are just there to get donor money and tick a box that they have trained 50 or 100 youths or 500 women on digital skills or whatever. And once they tick that box, they move on. And so that is what causes most of the failure within the innovation hubs. They are more focused on, they have forgotten their core client is the startup. They have taken the funder to be the core client. So what the funder wants is what the funder gets. And when the funder goes and another funder comes with different demands, and the funder here I mean donors who are giving you grants, you change everything to suit them and tick a box. And that's failure from one go. But when you're focused on the startups themselves, then your programming will not be around donors and meeting their impact numbers and giving them the numbers. It will be around how many startups are coming out of this place and going into the market and scaling. And that will take you to the fundamental question of entrepreneurship. Entrepreneurship is about finding a problem or a need and finding the right solution for it and getting people who are willing and able to pay for it, and then being able to assess and know how big the market is that you're going to serve and going in and serving that market and having a clear strategy of continuously acquiring more customers and growing your customer base using very practical channels to get of sales and distribution to get to your market. If you focus on building those trends within those startups, then you'll have done 90% of the work. But of course, there's the governance aspect of it, where you have to strengthen these startups and make sure that they have proper governance systems, they are legally registered, they have the licenses they need, and they have policies and frameworks to guide how they operate internally, because they might also as well fail because they are lacking internal structures. So if they just operate randomly, they'll be doomed to fail. The other component that makes them fail is they don't have the capital to actually pilot, or even after they have pilot, they don't have the capital to scale whatever they have proven that can work, and there's a product market fit. So, and that's where now the whole concept or question of how do we fund these early stage businesses comes in. And in my own submission, I believe every innovation hub should have a funding component to it, so that these startups at the initial stages, once they have been capacity built, once they have validated their market, once they have a proper product market fit, and they have a clear market path, go-to-market path, and they know who their customers are and they can reach them and scale, then you give them the capital they need to boost them. And you don't have to have this capital in-house. Now that's where the whole issue of partnering with different investment or investor groups comes in. You could partner with other impact funders who use your hub as a source of pipeline. You could partner with VCs, early stage VCs. You could partner with angel networks within your country. You could partner, or city. You could partner with individual angels who also are looking for pipeline to support, and then you link them with the startups that you have polished and are ready for the market. So your capacity building work should be around making sure there's a product market fit, there's a big enough market to be served, and de-risking the startup by putting in the right structures in it, and then presenting it to these different investors so that you fill in the gap for the investment part. So I want to move on so that I don't dwell so much on that question, but I believe you have gotten all the different areas where you can fail and how to respond to them. The next question here is, in Uganda, more than 80% of business startups don't make it to their first birthday. This is mainly attributed to lack of capital or availability of costly capital, In your experience, what is the best way for startups should manage the financing challenge? Yeah, well, everyone wants money. Just came back to Nairobi from another city here called Mombasa yesterday, where we were having a training on investment readiness for about 50 MSMEs and startups. And this question was there, like, how best can we access capital? And the short answer is there is limited supply of capital, and there are so many startups that want to access that capital. And so the question here is, how do I stand out as a startup for me to attract capital into my business? And I think, again, you have to think like the investor. The investor is thinking of, I have 100K US dollars, and I want to generate 50K on top of it in 2-3 years. So when you are going to the investor to seek for the 100K to invest in your startup, what you want to demonstrate to them convincingly is that the 100K can be turned into 150 in 2 years. And so the only way you're going to prove to me that you're going to do that is if you show me that there's a market that is going to actually buy from you once you have used the money to probably buy inputs, pay your people, and expand and whatever. If you show me a clear path to how you're going to get to generate more money so that you're able to repay me my 100K and pay me a return of 50K and still have some money for your business to continue existing, then we'll have a conversation. Investors are very rational. They're looking for returns. So there are two things you have to realize investors are looking for. We are looking for one, return when I'm assessing a startup that I want to fund. I'm looking at return. Number two, I'm also looking at the risk involved. So if you show me that you can get me back my 100K and also give me a return of 50K in 2 years, and there's a clear practical way in which you're going to get into the market and do this, the only missing part is my money, my investment. And once I do it, then the path to scale is opened up. The other thing I would ask myself as an investor, or what I usually ask myself before I invest, and coincidentally, today I even actually did a transaction as an angel in as a startup here in Kenya. One of the other things that you have to prove to me, and you have to do the presentation, is a clear, well-researched kind of presentation is what are the risks involved as we pursue this goal of you investing in me and getting your returns, and how are we going to mitigate these risks so that we do not end up losing the principal and we also do not end up losing on the returns. So you have to show me those two things. They are very important. Show me the path to getting the returns, how the money will be multiplied and how you're getting there, and show me how you're mitigating the risks. Now, how you're going to get the money goes back to the fundamental question of entrepreneurship. You must have customers. You must have a market. It goes back to you validating your market, making sure the market is there, the customers want and love what you're offering, how you're going to continuously innovate to meet their needs, and how you're going, the sales and distribution channels you're going to reach them. If that is clear, then I can see the path to you making the money, then the investment will be done. So I think that's a high level kind of general comment around startups and them being able to access capital. And any investor who is looking for a return will definitely fund you. Of course, there are impact investors who are also looking for impact on top of the returns. But truth be told, everyone wants a return. Even the so-called impact investors at the back, in our back offices, what we are discussing is, yes, impact, but the return needs to be there for us to sustain even the fund itself into the future. And now the other thing to look at and to consider is, well, I'm still on this point, is where are you going to get this money from? Because different businesses, different sectors would require different sources of funding. And you might waste a lot of your time knocking at the doors of VCs. And whereas your business probably could have gotten money from a credit union or an MFI, a local MFI, or probably even from your bank, or probably from even an angel investor or an angel network. So also knowing the stage where you are at as a startup, the amount of money you're looking for, the ticket size, the sector, and understanding your geography and the investors who are interested in that geography and who are investing in the same sector, in the ticket size you're looking for, it would be good. Doing your homework around the different instruments available out there that are good for you, and which one you can go for, and then preparing for that, what we call the investment readiness for whichever type of investor you're going for, would also be ideal to overcome the challenge of getting no every time because you are not approaching the right investors. So I think that one helps. Again, happy to pick it up and continue further because I can see there's so many comments. I would want to go through them very fast. Our time is up. So what criteria do angel investors in Uganda prioritize when evaluating potential startup investments? Ray, Mark, student. I think I already answered this. It's not only in Uganda. Investors are investing across borders nowadays. Angel investors, we're doing investments across board. And so the criteria is basically simple. Show me the returns and how we are going to get the returns. Also, show me the risks involved in this investment, specific investment, and how we are mitigating it, and including all legal issues, etc. And then, if it is up to my risk appetite, and I see these mitigations that is good, and the returns look good, then I'm going to invest. So I think that one is handled in my previous comments. Ugandan working definition, an entity of at least 12 months old that applies innovation and technology to develop a disruptive process, product development. I think that one we can all read. It is the startup definition there that has been shared. What are the key factors, again, Roy, that make startups an attractive investment opportunity? Again, just to re-emphasize what I've already mentioned earlier, the fundamentals of entrepreneurship. You must have a customer who is willing and able to pay. And that customer needs to be replicated. That makes a market. You must have a market, and the market is big enough and growing. And if I see the market is big enough and growing, and your solution is actually liked by the customers, meaning that there'll be customer stickiness and loyalty over time, and the returns are looking good, then I'm going to invest. So there's something that most startups don't think about consciously, but that's how we think from an investor point of view. It's the unit economics. You could have a big market that you're able to serve, and you're showing me a clear strategy on how you're going to get into the market. But the cost of you getting those customers and getting into that market is so high, so that the margins are not making sense. By the end of the day, when you factor in inflation, you factor in taxes, we might end up not making money. So I'll also be keen to look at the unit economics. What is your cost of acquiring a customer and basically running your business? And what is the value or the price that customers are paying for whatever you're selling? And when I look at what we call the lifetime value of your customer, basically, how long are you going to keep that customer buying from you, and how much are they buying every time they buy? And I look at the cost of acquiring the customer. If the cost of acquiring the customer is too high, even if the market is big and I'm not making good margins, then it would be attractive. So beyond looking and considering a big market, which must be the basic thing, are there customers who really love the solutions we're providing or products? The next level is the numbers. Are we acquiring these customers at a good price, such that at a low cost or at the right cost, so that the margins are making sense? The investment side of things is about returns, so you have to show us how you're making the returns. You can access this working definition. Okay, that's an explanation. A question here from Local is, how can investors conduct due diligence on startups to ensure they're making informed decisions? Very profound question. Again, earlier this week, I think on Tuesday thereabout, I was facilitating a session with the East Africa Venture Capital Association. They were doing their professional development program for investors and other stakeholders within the investment space in East Africa. And my session was on markets and commercial due diligence. And what I would summarize from that whole discussion is what I've been emphasizing on. When you're doing a due diligence on a startup, first go and check whether they have customers, paying customers, uh, and assess the market that they are in so that you're not investing blindly. And then because they just showed you that they have 100 paying customers, probably that's all there is. And when you go in as an investor, you're investing for the long haul. And so you must do your market analysis, and then you also have to do your commercial due diligence. Very important. Of course, the other things about finances, legal registration, the team, the policies, you have to interrogate all those. So you must have your tax due diligence, your financial due diligence. You must do your legal due diligence. But from where I see it, why most startups fail and why investors lose money is because they don't pay much attention on the markets and commercial due diligence. And that's why we were training these investors earlier this week on how to deep dive into that particular segment or component of due diligence. And that's what I would recommend also. And in summary, how you look at it, you're looking at the macros and the country, in this case, Uganda. You're looking at how the GDP growth, you're looking at inflation, you're looking at forex exchange and all those kind of things if you're investing in hard currency. And you're seeing where they are trending and where they're going. You're then going down to the sector within which the business is, and you're looking at how the sector is working, the regulations, the new technologies there that are coming up, and how they're impacting businesses within that sector. And you're looking at the competition within that space and trying to figure out whether these guys can survive. And then you're going to market sizing. You're trying to assess within that specific sector where that business is, how big is the market? You're investing into the future. If the market has already been taken and they have, then it's gone. So your money might not grow because the way your money will grow is when they are growing their market share. So you look at the market size. Is it big enough? It's such that if you invest in them, they can scale and grow, and then you are able to get back your money in whatever multiple you desire, 3x, 5x over whatever period you have put your money in the business. That has to be done. And then the fourth and the last thing that you need to look at when you're doing the market analysis is obviously the ease of access to the markets and the barriers to entry. So can anyone else just come and do whatever this startup is doing the following day? As an angel investor, most likely your amounts are not very large. From the typical, most of the angel networks across Africa, even here in Nairobi, the entry point is you just required to invest $1,000 US. Rarely will you find angels in this part of the world investing 100 K USD in a startup or thereabout. Most of them will be coming together and syndicating 5K, 2K, 3K, 10K, and then they are able to raise the 50K or 100K that the startup wants. And so you also want to invest because the 5K to you is a lot of money probably, or the 10K is a significant amount of your savings. You don't want to put it in a startup that the following day some VC comes with with $1 million US and puts it in a competitor and you are wiped out. You want a business that is in a sector where it's showing its uniqueness. It has built a moat, what we call a moat around itself. It has a unique selling proposition that kind of gives it an advantage to continue existing in the market so that your money can actually grow as the business grows. So those are the things to look at. Of course, under commercial due diligence, you're looking at competition and trying to see how easily can these guys be, who are the other players in the market, how big are they, global, regional, local guys, and what threat do they pose to this startup. And as you assess that, you see, is there a big threat that once I invest, probably these guys are not going to be there for the longest. You also want to assess the competitive dynamics in that market. So you're assessing price wars and how they fluctuate and who is controlling how pricing happens. Do the startup have a leeway to price profitably? And what will the competition do in that case? Product differentiation is also another competitive dynamic that you look at, and you want to see how are other people differentiating themselves, and how is the startup that you want to invest in also positioning itself and differentiating itself. So those are some of the things that you really want to consider. And of course, you have to look at the economic, then you have to look at the risks. And in this case, I categorize them into three. You need to look at the economic risks, which covers anything around the inflation rate, the exchange rates, etc. You have to look at regulatory and political risks in terms of policies that are governing and influencing the business and the sector it is in. You have also to look at the operational risks, anything that could affect the supply chain and the day-to-day operation of the business, and even things like infrastructure in the country if you're investing in an agri startup. Things like workforce availability if it is high tech and you need some skilled labor. So all those operational risks, economic risks, political and regulatory risks have to be considered in the due diligence. Again, this is a whole topic by itself, wide, detailed, and there are frameworks and different things to do around that. But I hope that helps to give you a snapshot that due diligence is not a walk in the park. If you don't want to lose your money, you need to invest in it. I'll move to the next question, which is on and how can investors mitigate risks when investing in startups? So risk mitigation comes in different forms. You could take insurances, if it is political risks, political insurance, etc. You could have clauses within the investment agreements that kind of protect you from recklessness and other things that the startups could do that could pose a risk to the business. You could basically transfer or manage it within the startup. When it comes to risk, you can either transfer or manage it. So transferring is insurance, managing is finding ways to lower the risk of that happening. If it is infrastructure challenges from an operational risk point of view, you can figure out probably better routes through which the goods can be transported to reach the market earlier and safer so that you don't incur losses during transportation. If it is power that you don't have in that place and it is required, probably think of renewable energy sources that could be installed there. So again, risk mitigation is on a case-by-case basis, but from a fundamental framework point of view, you're looking at how do I transfer or how do I manage it within the organization? Again, a long topic that we can discuss some other day, but I hope that helps. I see here no one has biogas and fertilizers and how much would be required. I think the straight answer there would be dependent on the size of the project. Some projects would require below 100K, others would require millions. So again, happy to sidebar on that and understand more the need. Davidson asks, what are the key steps for establishing VC fund in Uganda or East Africa? Good question. And I don't want to dive into this particularly today because each country has its own regulations and guidelines on how to set up these funds. But generally, the structure of a VC fund would be you have general partners who are the people who are setting up the fund. It's a fund management company, could be the general partners or other people. And then you have limited partners. And these limited partners are the people now who put money into the VC. So technically, you'll be managing other people's money. And as a VC, you'll also go fundraising the same way startups will come to fundraise from you. You'll go fundraising from the different limited partners who put money into your vehicle, and then you're able to invest in these businesses. So the process would obviously start with you thinking about where do you want to invest, what the size of the fund that you want to create, which sectors, what ticket size will you be investing, which geographical coverage will you be having. And then once all those are determined and you've prepared your investment hypothesis and investment case, now you go roadshow. The roadshow is basically you going out there looking for the limited partners. You as a general partner in the fund, going out and looking for limited partners. And when you talk about limited partners, we are talking about Mostly you'll find their DFIs, development finance institutions. You'll find ideally our pension funds should be institutional funds like pension funds, insurance funds, endowment funds from universities and other institutions should be the people who put money into the VC. And sometimes if they are government backed, if there is a fund from the government, you can find a bit of funding from that source, from those sources. But then the next step ideally then be after the registration, depending on the specific country regulations, then you'll go doing a roadshow and raise the funds, and then you start deploying the capital. So that's the high level kind of process. You first have to define whatever it is. It's like a business that has to create its own business plan and then register and then go fundraise. It's basically the same path, but now from an investor point of view. But again, this is unique per country. And like I said earlier, we don't have strong, well-defined laws in most African countries. I would be keen to check further, double click on Uganda and a few of other East Africa countries to just provide more context on that. There's another question here. How do you value a startup that is either a prototype or proof of concept or early stage revenue, but claiming to have so much potential? This is a good one. Every entrepreneur, for your information, they are very confident in their ideas and they're very ambitious. The very fact that they chose not to be employed and to take the risk of starting a business tells you that their mindset is already steeped towards thinking big, being ambitious, and that's what they'll project when they are having the evaluation discussion with you. So the best thing to do is to avoid having the evaluation discussion at that time, at that point. And you can invest using other instruments such as SAFE or convertible notes that you can convert later when there is proof of traction. That's a straight up answer. And when they are in early stage and they're generating some revenues, and you can then decide to use the multiples valuation method. This is comparative, basically. You are taking another company, similar stage, almost similar revenues, similar growth stage, basically, in the same sector, within the same geography. Probably an investor did a valuation of the company and invested in them, and they invested at a valuation of, let's say, 5 times their revenues. And then you can apply that multiple on the startup that you want to invest in. But again, that is a very wide topic on valuations that also has to be covered in a different context so that we go into all the different valuation methodologies. But straight up answer, don't go into valuation at that stage. Invest using other instruments so that you delay the valuation into a later stage. The SAFE, simple agreement for future equity, is a good tool to use. Again, it has not been recognized by most laws, but we still use it anyway. But it's a safe tool to start with. The next one is the convertible note. So you don't have to do like a straight up debt. It's a convertible note that says, this money I'm giving you, you can pay me back if you meet certain criteria. If you don't meet certain criteria, then you pay me back. If you meet certain criteria, then I can convert it into equity. And you give the business some time, the startup sometimes, to show some traction and proof. So avoid valuations when it is, because you'll be valuing air and you'll buy air, and you'll have yourself to blame. The next thing is the next question. Trying to scroll them down here. I need to know more about angel networks. Happy to again provide more context, but basically how angel networks work is, I'm an angel investor. I have some money. I want to invest in startups, but instead of investing alone, I look for other people that we can invest together. That's called syndication, and we have not formed any kind of formal arrangement. I just look for my 3 friends and I tell them there's this startup in healthcare. They're doing some really good thing around vaccinations or distribution of medicine, and they need 50,000 USD. I have 10K. Can you come together with me and we invest? You syndicate. Now, angel networks now are more structured. You are coming together to form a network of different angels that co-invest. And the way the angel networks work is I have a deal. I found this healthcare startup, and we are an angel network of, let's say, 15 people. Out of the 15, probably I know there are 3 others who are interested in healthcare, and I would approach them and tell them, I have this deal. Can we go in together? And then we can go in together with the 3 others who are interested. and we invest in that startup. So it's again a concept that we are building around, and that's really what we are working on at African Federation of Business Angel Networks, is to bring different individuals together, angel investors who are investing individually together so that they can start co-investing. Why is it better to work in an angel network? Because you are distributing the risk. Instead of putting all your money in, if you had, let's say, 20,000, or let's say 30,000 available to invest, instead of putting all your money in one startup, you can put 10,000 here, 5,000 there, because you are co-investing with other angels. So you are de-risking your portfolio. You're basically lowering your investment risk. And you also benefit from the advantage of, if I'm investing in a healthcare startup, probably another professional within our angel network, another angel could be within the healthcare space. And so when you're doing our technical due diligence to understand the technical stuff about the healthcare now sector, that person becomes in handy as a lead in terms of technical due diligence. And then you probably have an accountant or someone in finance space as another angel that you're co-investing in, and they can help in the financial due diligence. So again, it kind of helps in the due diligence process, where you have experts who can actually help you to analyze the startup better, so that you don't end up with a startup that is a fraud, that keep publishing vanity metrics, that delude you into thinking it's a good thing, but it's not. So by crowdsourcing different expertise within the network, we are able to assess startups better. But the most important thing is you're de-risking your portfolio by investing with other people, and not taking the whole hit by yourself. And most likely, you're going to make a good decision if you collaborate with other people when assessing different startups. Given a country like Uganda, where angel investors and VCs that are native do not exist, unlike Kenya and the Big Four, what would be your recommendations to build such networks? So the first thing is, if there is first thing first, even in Kenya, we are still building the angel networks here. It's still a nascent new concept. It's still work in progress. We might be a few steps ahead, but we are not far away from every other person. That just putting it out there so that we know. Now, in a country like Uganda, what then do we need to do? I think the first thing is awareness creation. Kudos to those who organized this session and this whole webinar series. This is the first step towards having those angel networks and VCs being created locally. Awareness creation, so that people understand that there's an asset class that you can invest through, called startups, through angel investing and VCs. Awareness creation is needed. Demystifying the risk within the startup ecosystem. Working with the enterprise support organizations, so that they stop focusing on grant funders and donors in terms of pleasing them, and they focus more on supporting the enterprises and the ventures, so that we build sustainable and scalable businesses that can be invested in. So if you work around awareness creation, and if you work around building a good pipeline of startups that can be invested in, that have clear markets and clear path on how they're going to scale, I think you're going to deal with that issue of starting to make people now start warming up. And it's going to take time. Trust me, it's a 10-year journey. I've been in this ecosystem in Kenya for the past about 10 years or so, and I've seen it evolve. Within the first 5 years, it was slow. After the next 5 years, it started picking up and becoming very fast, and things changing. And so I would expect that over the next 5 years, if we keep on with the momentum of awareness creation, of building proper startups that are solid and fundamentals are right, and that have good markets and clear paths to scale, then I think we'll start appetizing more people towards that space. So awareness creation, very important. There's the policy aspect, so that the angel investment and VC can also be recognized within the law as asset classes, and how their unique dynamics be appreciated, and be so that we have legal framework within which to operate. That would also be a big boost because it reduces the risk, so that when URA and others come, you have a framework within which you are talking to them. and other regulators. So there's the awareness creation, there's the policy side of things, and there's the pipeline side of things, of building proper pipelines that then feed these local investors. So it's a kind of multi-stakeholder approach where those who are in the investment space are doing the awareness and providing the support, technical support needed to set up these kind of investment vehicles. Those who are in the startup side of things are doing their part in creating and developing solid pipelines. The policy people in the government side are also doing their thing in making sure that the policy environment is supportive of such. So if you approach it from those different angles, continuously over time, things will look better. And like I said, as I leave that point, is we are all growing and scaling, and each country is at a different level. Even in Kenya, we still feel like we haven't started working at the level where we would want the market to be. So we are actively working around awareness creation and supporting creation of new angel networks, local funds that are funding SMEs and startups. And I know FSD Africa is doing quite a lot of good work in that space. So we are all in the same boat, trying to be better. There is Dorcas who is asking, hello, thank you for this insightful information. My question is, what would it take to convince institutions such as banks to create startup products? Well, Dorcas, I think me and you share the same sentiment on banks. They are high risk. They seem not to understand startups, and I interact with them on a daily. Obviously, they speak a lot, big things. They have media announcements and press releases on they have received X amount, millions of money that are supposed to lend to SMEs and startups, but they rarely do in the way that we'd expect that they do. So how to convince banks? It's also a question that I'm still struggling with. Honestly, someone needs to do a proper study on banks and why they lie to us. Because when you look at the press releases and and now you take a startup to them or an SME to them to fund, a different story. And this is the story of my life, because on a daily we are working with businesses to fundraise. And the first question is, who is your banker and what are they saying? Why can they fund you? So that we look for other alternatives. And the same stories, their stories are the same. Collateral, they cannot lend me beyond a certain amount because of my size, and I need yet more money for me to scale. So that's a challenge that exists in our markets. I don't think we're going to solve it anytime soon, because credit guarantee and credit enhancement products have been brought and tested, and probably I don't know whether they're not working or banks just prefer to do the safe thing, get the money because they're having depositors' money. To be fair to them, they're having depositors' money, which they should not lose. They prefer to go to the safe government bonds and other corporate bonds that are much more safer. And then they have really little left for the smaller businesses that are high risk and that would end up making them have high non-performing loans. And so, to be fair to the banks, they have a mandate to protect. They have prudential guidelines, like I know we have here in Kenya under the Central Bank of Kenya, that restrict what might be considered reckless lending to high risk loans or high risk loans that could probably lead to the bank having very high non-performing loans, which could lead to probably a contagion within the financial services sector, and then the whole economy collapses. So I understand them where they're coming from, but when I'm with my businesses, I would rather they have structures that are more lenient, more flexible, looking at cash flow lending, so that every business is assessed based on its risk profile, as compared to always requiring collateral and other things. But I think that is not yet to change. That's not going to change anytime soon. So probably the better way to look at it is, what are the guidelines, prudential guidelines from the central banks that actually prohibit them from doing lending to the kind of startups that we support? And number two is also to look at what is existing, the credit guarantees, the credit enhancement products that they have, the insurance, the SME and startup loan insurance products that could be there, that now protect the banks. And it should be also a multi-stakeholder kind of approach for us to get a solution there. Again, a beautiful topic that we could discuss and brainstorm on for a long period. And finally, why are investors in Uganda hesitant to fund fintech solutions like payroll management despite strong SME demand? My company, Ivy Workforce Solutions, already serves multiple clients with proven HR payroll tools and has a clear innovation plan. What's missing for investors, and how can we bridge this gap? So, Shafiq, again, depends on the investor that you're targeting, and the investors have different investment mandates. There are specific sectors they invest in. There are a certain level of growth, stage of growth, early stage, growth stage, mature, or whatever, expansion stage that they invest in. They invest in specific geographies, and some of those key criteria. So first of all, you have to assess, am I approaching the right investors? Are they investing in my geography? Yes, they are Ugandan. They are investors in Uganda. That's what your statement says. Are they investing in my sector? So if they're not investing in your sector, no matter how long you keep knocking, they will not. Are they investing there at the stage of growth where I am today? Are they investing in that stage? That has to tick also. Are they investing at the ticket size? No, the instrument that I'm looking for. Am I looking for equity or debt? So are they investing that, or are they doing the hybrids? Whatever it is, you have to assess that. And number 5, are they investing the ticket size that I'm looking for? And if those things are not ticking all of them, then it might become a difficult discussion to have with the investors. And then obviously, if all those things are ticking, then you come back to your business. How much do I want to raise? How am I going to speak like an investor and convince this investor that my business is worth investing in? And the way to look at it is from a point of am I showing like the fundamentals again of entrepreneurship? Am I showing them the market? Am I showing them and how the market can scale? Am I showing them how I've created a moat around myself, the unique selling proposition for our business, so that you're able to create customer loyalty and be able to continue acquiring more customers? So those are some of the high-level things that I would be assessing in your situation before I'm able to address it deeply and give proper recommendations. And so I think I'll stop with that on all the questions. And apparently the questions have taken us for more than 1 hour. But I believe this then is more helpful than me preaching other things that probably you didn't want to hear. And so for those who asked the questions and those who related with the questions that were asked, you have been able to learn a thing or two. And just to summarize and finish, I would like to share with you one more slide. Just one more slide. So the whole discussion we've been having is how to get people to consider startups as an investment alternative. And this Africa, the big deal. They shared this report as of last year, and you realize in 2024 in East Africa we raised 725 million, of which a big chunk of it came to Kenya, 638 million, and 12% the other countries, of which I understand Uganda got about 19 million. And of the 19 million, almost 79% of that, about 15 million, went to Watu Credit. So still, you can see how skewed the funding landscape looks like across the region. And what does that tell us? That tells us that there's a lot more other startups out there that are not getting the funding they need. Because even when the 19 million came into the country, one company alone got 80% of that amount. And the rest, a couple of others, got the remaining amount. And so there are hundreds of other startups out there that are not getting the capital that they need. The same situation is in Kenya. Over the past 4 years, or at least 5-6 years, we have raised more than 3.5 billion US dollars in Kenya. And of that money, 50% of it has gone to 6 companies only, 6 startups, 50% of 3.5 billion. That's a sad state of affairs. The question then becomes, how do we fund all the others, all the other startups that we are supporting, all the innovation hubs that we are running across our countries? And that's the situation now, and that's the question we are supposed to answer now for for Uganda. How do we support these others? And the answer is very simple. We need to have our own local investors who are investing smaller ticket sizes that now can fund these other startups that don't get the big money from the foreign investors and other VCs that are investing in our economies, because they're all going to very few startups. So that's the challenge now that we have. That's what I would like to challenge all of us to think of. If these other people are seeing something in our startups, these investors who are coming from all over the world, yes, they are seeing potential in our markets, but they're narrowing down to very few. What do we do with the rest? The rest, then, it's up to us now to create opportunities for them through starting to invest as angel investors, as individuals, investing through angel networks, forming angel networks and syndicates to invest, forming local funds, and going to get the capital that we need from local sources. And I believe Africa has the money that it requires to fund its own startups by a multiple compared to what comes from outside. We have more than 440, I think, billion US dollars in assets under management by pension funds across the continent. If only they were to allocate 10% of that to startup funding, that would be 40, give and take 40 billion. Last year, the whole of the continent raised 2.2 billion for startups. I mean, but we could have 40 billion in our pot locally sourced from our pension funds in Africa. Think about that. And I think I'll stop at that point by just saying that we have the money in the continent. We just need the right people and parties coming together, create the awareness, and mobilize the local capital. And I think this is part of that initiative. And so I would like to congratulate those who are organizing this. And I look forward to seeing the results of it. We are here to support from African Federation of Business Angel Networks in awareness creation, capacity building, and supporting in mainstreaming these angel investments. And look forward to interacting with the Uganda ecosystem on that front. Apologies for taking too much time. I went to the questions, time has run, but I felt we should address the question asked because they're the ones that are now more relevant to the people who are in the session. Thank you very much, and back to you, Ken.
Thank you very much, Jeremy, for such a wonderful session. I think I've not had an engaging session as this in the Zoom engagements I've had, I think, for the time we started having Zoom engagements, like since 2020. And to me, that was just full of knowledge, experience, and great insights. And I believe everyone who came to this discussion, you at least have learned so much that can get you in a meeting, and you run that meeting for 30 minutes just talking about startup investment and what have you. I do want to add a voice to Jeremy's for those that attended. Kindly be champions, kindly be ambassadors to startup investment. As you've had, locally in Africa, we could possibly raise $40 billion dollars. However, we are here crying for just raising 2 point, something, which for the most part is externally sourced. And that goes back to our government. So if you are able to actually be the go-between, these conversations with government officials, the responsible people, taking the lead in convincing them, that would definitely be very, very, very helpful. And yeah, so again, I want to thank very much Mr. Jeremy for sharing, these insights. For your experience, very, very highly appreciated. And I think people on the call, you can use, reactions, icons to express your gratitude and love for the session. at any time as we wrap up. But I do believe that this is a phenomenon and is going to do a lot of transformation. We are going to keep posting these as recorded sessions on YouTube so that even those of you who could have missed this conversation and they were very interested in, learning or knowing such kind of knowledge, building more on awareness creation, so you can always, share within your networks so that anyone, it doesn't matter, by the way, whether you are an investor, whether you are in the field of finance and you want to take a career in this space, there are those proactive actions that actually will get this continent and Uganda as a country to start actually having its own resource basket over and above which startups can start tapping in. I thank you very much for the insightful questions you raised, which led to a great session. I want to also mention we were not so late. Meanwhile, Jeremy, we were supposed to stop at 7:30, and I know we first spent about 15 minutes waiting for a few colleagues. So not so late, but I encourage you to keep coming in time so that we are able to finish exactly on time. I want to conclude by saying that these sessions are brought to you by SFV, Startup Funding Vehicles. And this initiative, as presented by Eric, is an initiative that you can potentially also be a part of. And there are benefits of, having these conversations and attending, especially if you are a career person, you end getting a certificate. This could propel you to getting an opportunity in the soon to come or to start venture capital firms. You had people asking a lot about angel firms, VCs, how to start all that. Of course, when they start, they will be in shortage of human capital or talent. And you could easily argue that out and say, yeah, I know some of these things. Jeremy coming here and sharing his experience saves you a lot of 2-3 years of studying finance because he's sharing from a practical area of understanding. And of course, you being able to, for investors, you want to invest in a startup where you can come back and challenge them, where you can come back and, educate them on certain aspects, but as well as being able to make right decisions for investment. Lastly, but not least, is you can join startup funding vehicles as a different member or with a different member tier where these resources are meant to support the activity that we shall be doing. We would want to partner a lot with, institutions that are into media. Without media, we are not going to easily influence this space. So anyone who is connected into that space, I would want to implore you to reach out to us so that we figure out how to best collaborate, and some of these small contributions would be very, very helpful in terms of operationalizing and making sure that we continuously have this conversation. And by the way, we are not only looking at it from the angle of, if you noticed somewhere here on what next, we want to, build the Ugandan funding landscape, develop investor networks, supporting that, that space, startup investment support centers, diverse funding mechanisms, strategic collaborations, of course. So we would want to encourage you to reach out to us at Startup Funding Vehicles. At the same time, we are partnering with Uganda Management Institute, UMI, Uganda's premier institute in research, consultancy, management, and so on and so forth, long distance learning. And of course, GPAP, which is graduate professionals apprenticeship program or a graduate professionals program, where we empower young people who are just done with university to be job ready. And I want to conclude by saying, yeah, all coordinated by TechBuzz Hub and open to any other partnerships, collaborations there is, so that we can drive this conversation to higher and bigger heights. With that, I want to say you have been a very wonderful audience. I believe and hope you have learned a lot, of course, with the questions you posed, to make people understand some of these areas, especially those who did not have a good context of startups. I believe right where you are now, you are you could easily be able to make an investment tomorrow, you know, or discuss or urge out an entrepreneur to be able to invest in them. And with that, I want to call off this discussion. But again, thank very, very much Jeremy for accepting our invitation free of charge. This has not been paid at all, and you can imagine this could have been a 500 consultancy engagement, but as he said, him and Africa, him and the angel network that he works with are free to provide support in making sure that we build our local investment as Uganda and Africa at large. And yeah, I believe we can transform this continent together. The next session is going to happen next week, next week but one, and it's most likely going to be facilitated by a Tunisian who is going to provide a case study on the African continent. So do not miss on understanding who can an investor be, and of course, considering a case study in Africa that could have been successful with the experience and stuff like that. And there is a lot to learn from that. So do not miss that session. Feel free to register. The link remains the same. What changes is only the figure at the end. Until the 10th webinar, then we can be able to provide you a certificate for those that will have attended 80%. Of the sessions, but even those who will have not attended should you make 80% of the 10, even the continuous ones, you qualify to have that certificate. So keep coming, keep engaging, let the conversation keep up. I wish you all the best and have a blast of the weekend. Bye-bye all from TechBuzz Hub and Startup Funding Vehicles.
Thank you, Brian.
Cheers. Thank you, Jeremy.